Okay, so the Fed is getting ready to make another big announcement today. Well, maybe not as big as I'm saying it's going to be, but they're probably going to raise the Fed funds rate another 25 basis points. We'll see what's happening. I think the market is kind of bracing for that right now. So one of the things that I've been getting asked by people is, why are interest rates so high right now? And I have to kind of put this into context. So we're going to have a very high level conversation. I'm going to dig a little bit deep into the weeds. So for some of you who are not economists or really into that type of thing, some of this is going to go right over your head. It'll go in one ear and out the other. So I'm going to try to simplify this as best as I can. So the reason that mortgage rates are so high is there are a myriad of reasons. It's not just one thing, right? So there's a lot of angst that's going on in the market right now. And part of what's happening is moves that certain entities are making. So I'll talk about that in just a second. But what you should know is that there's something called a 10-year treasury note. It's really a government-backed investment vehicle for people who want to park their money into kind of a safe place, as not to kind of hedge their bets against the stock market, right? So if you're an investor, even if you aren't one, you just want to know this. You don't want to just be involved just in stocks. You want to diversify that portfolio. So one of the ways you do that is you have stocks, you have bonds, and then you may have some other assets. Well, the 10-year treasury note is one of those assets that you can hold. That 10-year treasury note is directly correlated with the 30-year fixed mortgage. They operate almost lockstep with one another. The difference between these two is what they call the yield. And that yield has been kind of uncertain over the course of times. And one of the things that affects that yield is something called mortgage-backed securities. Now, these are just simply, how can I put this? Let's say I'm going to use this bank. No, I won't use it. So you have ABC Bank that issues out all these mortgages, right? They're all kind of similar mortgages. And so what they do is they take each one of those mortgages, they bundle them together, and then they sell them as a security or an investment vehicle to people who want to invest in those, right? Because the risk with those type of securities has been a little bit edgy lately, that means that the yield or the interest rate on those mortgage-backed securities has to be higher because there's more risk involved in investing in those things. And because of that, that is pushing interest rates up as well. Now, you also have things like what the Fed is doing, right? So when the Fed raises their interest rate, which is called the Fed funds rate, that doesn't necessarily have a direct correlation with mortgage rates, but it does have some trickle down effect. And what do I mean by that? So when the Fed announces that there's going to be a rate hike, lenders, banks, all these institutions recognize that their cost of borrowing is also going to increase. So because their cost is going to increase, they have to pass some of that on to the consumer. That's you and I. So our amount of borrowing or our price for borrowing also increases as well. Some of that comes into play with the 30-year fix, but mostly it's in the form of like credit card interest rates, maybe school loans, private loans, things of that nature. But they still kind of bake that into mortgage rates. So that's pushing rates up a little bit higher. You also have these fears that we're going to be in an impending recession. So that's actually pushing interest rates a little higher as well. And then you have the negative news, which I won't start with that, but the news is really putting out all these kind of negative things that are going on in the housing market. It's not really that there are negative things going on, but that's the spin that they put on it. So you probably heard that the housing market is crashing or we're getting ready to go in a bubble. We're not really going into a bubble. So just think about it this way. In 2020 and 2021, we had the pandemic. So we saw interest rates go extremely low, almost to the bottom. And then we had a lot of people who want to take advantage of that. So they jumped into the market to buy. Well, we didn't have a lot of inventory. We had this much inventory and this many buyers. Now, even with interest rates going up, that buyer pool shrank from like here to here. But the inventory was still this small. So you still have a supply demand issue, which means that houses are still selling, albeit not as fast a pace as they were back in those pandemic years. Now, when the news sees this and they see the housing market is slowing, they want to say that the real estate market is crashing. It's not really crashing. It's really course correcting itself. So if you're a numbers person like I am, and you have places like, let's just say, and I'm not picking on them, let's just say Austin, Texas, who saw real estate values increase by like, 60%, right? So when that course correction comes, Anything that offsets that, right? And let's say that they say those prices in those markets are down like 40%. Was that really a crash when they were up 60%? No, it's really that the market is correcting itself. So you just have to have the information and stay informed. And that's one of the things that I do in terms of my job, is to make sure that you have the information, that you're educated on what's really happening, because you need to have informed data to make informed decisions. So if you need additional resources, I'm happy to share some of the information that I have with you. Again, I know this was kind of high level for a lot of people. Please don't be mad at me. If you need me to kind of make it more simplistic, just let me know. We can have a one-off conversation and I'll explain it and not make it so high level. But you just need to know the reason that mortgage rates are so high is partly and mainly because mortgage-backed securities and what's going on with the risk inherited with the yield that is attributed to those type of securities. So now you know, hope that helps. If you are looking for interest rates to drop down to the 5 level, which I believe that's kind of the magic number that people are waiting for, I'm not mad at you. But if you're waiting for that to happen and you think that I'll just wait till interest rates drop and then prices are going to drop and then I'm going to get a good deal, that's really good in theory. The problem is that everybody has the same opinion. So what's going to wind up happening is we're going to see interest rates hit 5, prices are going to cool. You're going to get a flood of buyers that come back into the market. But remember, we still only have this much inventory. So now we're going to be looking at 2020 and 2021 all over again. My advice to you is, if you can afford it and you're comfortable with the monthly mortgage payments being where they are at the interest rate you're quoted at, buy now. One of the reasons is you're going to be comfortable. You're okay. Remember, I said you want to be comfortable. And 2 is you'll be able to recognize any equity gains that happen over the course of the next 6 months, 12 months, 18 months, even 24 months. When everybody else is scrambling to get in, you'll already be in the pool and living lavishly. The other piece of that is, if you can take advantage of being able to refi, you can definitely do that and lower your monthly mortgage payment. Now you definitely have a win-win, because you have a much more affordable mortgage and you still recognize the equity gain that goes along with that. So again, if you need additional help or resources, please reach out to me or my team. We'll be more than happy to help you. And until then, I'll see you next time.